You're listening to Ecosysteming, the podcast redefining economic development through the lens of equitable entrepreneurship, 2 decades in the making. Join NC Idea's Tom Rue as he engages with entrepreneurs and experts who are challenging the status quo and driving lasting change.
Welcome, listeners of the Ecosysteming podcast. I'm your host, Tom Rue, and today I am joined by, frankly, a legend in North Carolina entrepreneurship ecosystem, Scot Wingo, co-founder, executive chairman, CEO of Spiffy, and general partner of the Triangle Tweener Fund. Prior to those current gigs, his entrepreneurial pedigree, as most of you tuning in would know, span multiple startups and exits, including the IPO of Channel Advisor in, was it 2013?
Yep.
Mm-hmm. Yeah, 2013. And as I said, I candidly, I don't believe there's a person tuning in that doesn't know and hasn't heard of you, Scot. So thank you for spending a little bit of time on our podcast today.
Thanks, Tom. Thanks for boosting my ego. It's been I had to clean up some dog mess this morning, and it was just kind of like one of those days. So now I feel better. Thanks.
Well, I'm glad I could provide that service. But I doubt you have to go very long without somebody willing to acknowledge what you've accomplished. And all kidding aside, it's impressive, and it's impressive. And from our standpoint, it's more than just impressive. It serves, and you know this better than most, it serves aspirationally for those who aspire to follow in your footsteps, right? If you have to see it to believe it or see it to be it, your exhibits 1, 2, and 3. And that simple fact alone is part of what you give back to the ecosystem that you're so generous in providing your time and talent to. But it was really, as we talked a little bit earlier, it's not so much your historical achievements, because there is a lot of good source material out there. And I would encourage people to do a quick search on Scot's name, and you'll find a lot of great podcasts where he explains and shares a lot of that journey. But I think it's the Tweener Fund, that is of particular interest because it's in the present. I think it's also unique, and I mean nationally. It's a new model. Mm-hmm. I remember when you and your partner in crime, Robbie Allen, who was also a past grantee of ours, that we had the good fortune in backing in an earlier company.
He was Automated Insights.
Automated, that's right. Sorry. Yeah, you know my portfolio better than I. That's a little embarrassing.
There's a lot of companies in the Triangle. Yeah, it's hard to keep track of.
That there are. But I think that, Tweener Fund is really kind of redefining the kind of expectations around how a capital stack operates within given ecosystems. And I was hoping we could start with you maybe just doing a quick, soundbite on Tweener Fund, what it is for people that aren't familiar with it, and then kind of take the conversation from there.
Yeah, to kind of understand Tweener Fund, you have to go back a little bit. So the way I think about it is I have kind of 2 timelines. I have my founder timeline where I've started now 5 companies. Latest one is Refi Buy. And then my other timeline is entrepreneurship's been very good to me. I'm from a small town in South Carolina. I'm not that classic Bill Gates, Mark Zuckerberg entrepreneur where they're from a big city, went to a private school, went to Ivy League, and dropped out because it was boring and they wanted to start a company. That's not me, right? So I went to the University of South Carolina. I'm from Aiken, South Carolina, which is a teeny tiny town, and then did NC State grad school on the engineering side. Part of my message, so another part of my timeline is I feel this, and I also had a mentor in my first business, Richard Holcomb, that gave very generously of his time, and I would not have been successful in that first domino that then allowed me to knock over more dominoes as I've gone. So part of my pay it forward is to encourage entrepreneurship, because I'm a big believer that it can, entrepreneurship inside of capitalism is how you can pull yourself ahead of the American dream today. And so I spend time at NC State and UNC and Duke and Elon and whoever will have me, I'll go talk about entrepreneurship. But then, so I've been at this 30 years. The first 20 years, and you've been here for a long time, we just had a lack of entrepreneurs. So it's really, we need more entrepreneurs. And so that's where I put my time, is trying to encourage entrepreneurship. And then between Channel Advisor and Spiffy, I looked out at the ecosystem, and we had solved that. We had like this Cambrian explosion of entrepreneurs doing all kinds of stuff. And the hard thing though was I wanted to mentor ones that were a little bit later stage, because over my companies I've gotten better at, I've built later stage stuff, and that's where I can add the most value. And it's very hard for me to mentor companies where you guys are at that kind of like napkin diagrammed product market fit. It just, an accelerator program is probably the best way to do that. And what you guys do with some grants there, just so they can kind of like get up off their legs and get going. So that's not my sweet spot. My sweet spot's a little bit later. So I started this thing called the Tweener list 10 years ago. And I basically said, we need a list of the up and coming companies. Maybe they've received a grant from you guys and they're getting some momentum. Maybe they've raised around, maybe not. Maybe they're even bootstrapped, but we should know who our rising stars are. And I called it the Triangle Tweener list. And I called it two things. I love the whole state of North Carolina. I know you guys have a broader spectrum than I do, but I had this feeling that I've spent a lot of time in our ecosystem, and there's like a lot of local pride in this ecosystem. And I think the more hyper local you get, the more that is. And that'll be a resonating theme to this. So hyper local is really important to people. They want to know what's going on in their backyard, and they want to contribute to it and be part of the hyper local ecosystem. And then, so I did that, and I basically, I did all this analysis, and I came out that if you had 10 people or a million, that was kind of where I saw a break in the data, that we had a lot of companies underneath that and not that many above that line. So I thought, that's the line we need. Above that line, we need to grow more. And at that point in time, we had 60 that I could find. Fast forward to today, there's 310. So we as an ecosystem have 6x'd that cohort of companies that are kind of like our rising stars. A lot of companies on that original list have been huge stars. Pendo is obviously on there. Several of Mike Dornberg's companies have come and gone and been sold off the Tweener list. Archive Social. It's kind of fun to go back to that list, and actually kind of need to write a post on this. And so then over those 10 years, though, I started tracking the number of companies on the list, how they did, how many closed, how many were successful, how many exits, and how many raised money. I'm an LP in the local funds, co-founders, Bill City and Idea Fund, and their pitch is pretty similar. And they basically say, look, we're going to have a minimum check size. We're going to raise a round of, and it's gone from 10, 20, 30, 40, 50, 60, 70, 80. They're kind of at 80, but when I started, they were at 10. And we're going to invest in 10 companies, and a third will be zeros, a third will return the money we put in, and a third will be power law companies and return the whole fund. And that's how we get to a 3 to 5x fund. That's the pitch. And I always thought there's an interesting analogy with the public stock market where, Warren Buffett would tell you, I'm good at picking winners, but you shouldn't do that because I've spent, 80 years doing it. You should buy an index fund. And I always thought, well, why isn't there an index fund for private companies? So in 2000, late 2021, it was kind of post-COVID, I started really thinking about this. Some of the crowdfunding people, I'm sure you run into this. We have a very vibrant crowdfunding, and I love those people. They're all great. But they wanted to do a crowd fund called Tweener Crowdfund. And I didn't really want to be associated with that personally, because I like crowdfunding, but there's still, not in North Carolina, but in other areas, it feels a little too risky. And I didn't want some little old lady putting her retirement into something and blaming me that it didn't go. It is like, startups are like super risky. And I like this accreditation rule that exists out there, that people have to be financially sophisticated to do this. And I wanted to make sure I had some control, that people weren't putting their life savings at risk, because I wouldn't be able to sleep if that happened. So anyway, I ended up starting the Tweener Fund in 2022. I found this platform that AngelList has called a rolling fund. One of my other goals was, as our local VCs have gotten more successful and gotten up to like that $80, $100 million range, their minimum check size has gone from 100K to 400K. And if you're, at Channel Advisor, for example, one of the fun things about going public is we minted many new North Carolina millionaires, right? These are folks making $1 million or $2 million, which is great. And they wanted to invest in startups, but if the minimum hurdle is $400,000, you would be very foolish to do that. So we had like orphaned a bunch of people that wanted to invest in startups, but they couldn't invest in the local VCs. Some of them will be in the local entrepreneurial groups around the universities and angel groups and stuff. But you also don't want to just go write 3 checks yourself of 25K. That's hyper risky because the failure rate's pretty high at this early stage, and the chances of all 3 of them failing is pretty great. So the idea of Tweener Fund has a couple things to it. Number one, it's hyper local, so it's only the Triangle, and we have a pretty. This upsets our friends in Wilmington and Greensboro and the Triad, but that is the window. That's our commitment to our investors, and that's what really resonates with them, which is why we do it. It's not that we don't love the rest of the state. It's just kind of to your point, I'd love to expand into other parts of the state, but I think it would need to be a rest of North Carolina fund or a Wilmington or a Western North Carolina, something like that. We can talk about that. So it's hyper local. Number two, it's got ecosystem support, but not in the nonprofit way. So the CD doesn't support it. You guys don't support it other than having me on a podcast. And it's really like, I view it as the pay it forward fund where, entrepreneurs like me basically saying, hey, we're not going to have success and pull up the ladder. We're also not going to be successful and just leave town. So it always frustrates me when entrepreneurs do that. They're like, I was in the Triangle and I sold my company for 150 million and peace out. I'm now going to California, or whatever. That's fine and that's their choice. But to me, like, you're investing in this ecosystem, you need to be here and stay here.
And the ecosystem to probably help them attain that level of success.
Yeah, they kind of like they kind of carpet bagged, right? They came into the ecosystem, filled up their bag with our goodness, succeeded from it, and then left and didn't contribute back into the ecosystem, which is a choice. And, I don't understand it, but it's just like not who I am. So, yeah. So the last piece is it has a really low entry rate. So it's a $30,000 commitment. And it's a year, and it's got what we would call, when you invest in a venture fund, a lot of people haven't done this, you get these capital calls. They kind of come at the most random times. It's always like in an inconvenient time, like when you're about to buy a house or you have a kid going to college, you'll suddenly get a 30-day notice that you have to put $50,000 into this thing. And it causes a lot of commotion personally when that happens from a liquidity standpoint. So what's nice about what we do is it's $30,000 a year and it's $7,500 a quarter. And it's always the first day of the quarter. So we can tell you today what it will be in a year, when you'll have to need. So it's very known how the capital calls work. And then the last part is, I think of us as an index fund. So just like Vanguard is to the S&P 500 in the public stock market. So you have Fidelity, which is picking winners, and you have Vanguard that became famous by building indexes around stock indexes. So they have a Dow Jones, a Russell, and on and on. They even have ETFs and all that stuff. So the Tweener list is our index, and the Tweener fund is investing against that index. And the data indicates, there's no guarantee of future performance, but the historical 10-year data we have now indicates this is a great group of companies to invest in. Number one, because they're in the Triangle, they tend to be way more capital efficient than other coastal startup regions. Number two, the failure rate is pretty low. If a company in North Carolina can get to $1 million run rate, its chances of failure go way down because it's relatively easy once you have $1 million to be efficient here in the Triangle, because our cost of, in most high tech companies, the cost of an engineer is super low. In the news, we have Meta paying $100 million plus signing bonuses to people, right?
How insane is that?
Yeah, it is. It's a super specific skill set that maybe only 50 people in the world have. So I kind of understand the scarcity value of that. It's like an NBA player or something, like where you get this like hyper scarcity. But anyway, so we think that's a dynamic that's interesting. And then on the LP, the hardest thing about starting a fund is getting investors, and we call those LPs. That stands for limited partners. And we were blown away. So Angel has said, okay, when these rolling funds start, they usually start at 200,000 a quarter commitment, and they grow to 600. So in the fourth quarter of 2021, I started socializing this to, I had a list of 100 entrepreneurs I wanted to approach. and like 80 of them said yes. And I was like, okay, we're definitely onto something that's resonating here. That's before we even announced it. Then we launched, and we launched with $600,000. So we 3x what the normal fund does in this AngelList system. And there's this affinity. So folks like myself want to give back. They want a mechanism for it, and they liked this idea of the index strategy. And it's kind of set and forget for them. So Robbie and I make all the choices, but we're really just running on an algorithm. So the algorithm goes: if you come to us and you're in the triangle, you have $1 million in revenue, and we do a little bit of due diligence. It's very, very light, and that is enough for us to write a $50,000 check. And then after that, as you raise more, we want to put more in. So that was kind of a long answer, and you may have a bunch of questions, but that's the Tweener Fund in a nutshell, in the rationale behind it.
We'll get into a little bit more of the detail here in a second, but I'm distracted by something you've said now multiple times, that although you didn't use the word altruism, but there's like this altruistic component to the way you describe, funding and supporting the ecosystem. So I think, is altruism really a consideration in early stage investing?
That's a tricky word because Sam Bankman-Fried is associated with it, so I try not to use it. I don't know. He was like this aggressive altruist or something.
Okay, fair enough.
I would say our LPs, number one, they want to make money, so they're doing it for investing. But number two, it's kind of nice if you can do both, right? So if you can do both, that's an interesting element. It's like you and I meet a lot of these social entrepreneurs. A lot of people think, oh, it should just be a nonprofit, but they have a profit motive and they want to do good, and those things don't have to be mutually exclusive. And that's what we think. We think this is by far a great financial idea that's going to have huge returns. The challenging thing is, whenever you have a new idea in investing, it takes 10 to 12 years to know if it was a good idea. And I like fast, I like fast data feedback, and we're getting some, right? So we don't have to wait 10 to 12 years to get any data. So for example, we've had 4 or 5 exits already, which is kind of, I did not expect, that have been pretty material. We're starting to get some good data, and we can see that we've been at it 3.5 years. We can see the cohorts really starting to grow nicely and get into that, power law curve and things of that nature. But, we're not going to know how we're doing until, let's see, 2032 to 2034. So it's going to take a while.
For the vintage years, for sure. Yes, it's as I prepared for this, it's curious. There's a couple points that I discovered along the way, getting to know you better, where we actually have some things in common. I too have, it hasn't been for many, many years, but I too have written COBOL and assembler code, and I worked around, IBM ES 3090s and the ES 9000s, and still had to write job control language. And
Did you do punch cards? You got some good punch card stories?
I was going to say, our computer labs, we were the last class that had to take the card class. This was the 80s. And they kept them as an homage, at least through the 90s, from when I went back to campus, to see that they still had them in there. It's kind of like this relic of the past, how much better y'all have it now.
Yeah.
But then I also pivoted into distributed computing and Microsoft, and I was a double-digit Microsoft certified sales rep. I think my certification number was like 74 or something like that.
Wow.
And so we were part of a business that was basically figuring out the internet as Microsoft was figuring out the internet, which they almost missed. They were kind of later to the game.
They totally missed mobile. That kind of walloped them for a while. Yeah.
Yeah, it really did. But it's still a great company that enabled, when you look at everything that Bill has done, and, everybody focuses on the foundation. And this kind of ties into that altruism type question. But just the fact of what he created with Microsoft, the amount of wealth that was created by people that using his enabling technology to build companies of their own, right? This is what these people do for humanity, right? The entrepreneurs, they solve the world's problems, they create new wealth, and and that wealth then goes on and funds things and assets we take for granted in our society but are generally considered amenities, based upon what they fund in their name of their accomplishments. So and that's a big reason why I asked, is because, we are, of course, a nonprofit, a private foundation. Um, but we are also very unique in that regard. I was at the Kauffman Foundation before coming here, 7 years there. And fun fact, trivia fact, I don't know if you know this. Kauffman, during the time I was there, we did the due diligence and were one of the first investors in Angel List. So when the boys came to Kansas City to pitch the model, we were like, huh, you're going to kind of you can do some like crowdsourcing of like, hey, that sounds really cool. And so it was kind of neat to be able to, be involved at that level. But we are struggling in the sense that we now, have been at this. I'm coming up on my 10th year in this role, taking over for David Rizzo. Who, David and John and Lister, and you know all these people, right?
Mhm.
Um, they did something great in starting, but that was the old days of technology-based economic development.
Yep.
And you could almost predict what the outcome of that, with the benefit of hindsight, of course, right? Nobody was this, smart and prescient back in the day, that it would predominantly fund, white dudes in major metro areas that already had access to capital and networks and debt capacity and things like that. And if we really were going to be more egalitarian and unlock, humanity's potential by unlocking the entrepreneurial potential of all people, it was going to take more of a strategy to do that. And so I see, Tweener Fund as one tool that is doing that because, we share, it's got to be over 24 companies that, we have funded, that you have funded. And they're not all, a white dude from state with a B2B SaaS app that fills in the blank, right? You have, through your investments, also very much diversified what the face of entrepreneurship looks like in the state of North Carolina. Is that just a happy byproduct, or was that something that was a hopeful and intentional outcome?
We didn't make it a part of the algorithm because then there wouldn't be enough companies when we started, there wouldn't be enough companies, but you know, there's so many, we're invested in 153 companies. And I think I've never done this. It's hard to find this data, but I would guess we as an ecosystem way over index on female and other underrepresented categories. And I think it's just because our ecosystem's so open and welcoming, and our algorithm is blind to that though. So if you make $1 million, get to $1 million, and maybe that's part of it, right? It's an algorithm. It has no bias, right? So you could be, in any as long as you're meet our criteria, you're in North Carolina and you have a company that is venture backable, we want to invest. That's our inclination. So I don't know if that's it or just as an ecosystem we over-index. I don't know why it is. I'm happy it's there. I have daughters that I think they should have equal access to capital on the women male side, and I know many awesome entrepreneurs. Bill Spruill is kind of like he's probably the most well known on the for people of color success, and he had a hard time raising money, but I think it's because I couldn't even hardly understand what he was doing. Not that it was a bad idea. It was just like so ahead of, he was like, I'm gonna get all this data and I'm gonna put it on an API and then people are gonna pay me money for it. And I was like, why would they do that? Like, I just like didn't, he was so far ahead was part of his problem. I don't think it was like the whole thing, but so we do have a great cohort of folks. And it always, for me, whenever people outside the area start digging into our ecosystem, to me, it always comes back to the universities. Because we have such a great tier 1 universities, but we also have a great tier 2. So, like A&T has a whole huge thing. Central does. A lot of our historically Black colleges have entrepreneurship program, which I think is awesome. And I go speak at those all the time too. I just went to, I don't know if it's private or public. It's a charter school in Durham, and it's like K through 12, and they have their high schoolers, and they're mostly African American boys thinking about startups and things. And some of the questions they were asking, I'm sure you've seen this having done this for 10 years. The questions 10 years ago were like, how do you get, like, why do you do this? Why didn't you go to IBM? And how do you come up with ideas? Now the questions I get from college kids all the way into high school are, you know, hey, when you're deciding between a safe and a convertible note, what are some of the considerations? And how do you think about these trade offs of they're asking what I would think of as like third and fourth order questions? It's pretty wild. And a lot of that's because all this has become just freely available on the internet. But before, you know, this goes back a little bit further than 10 years, you didn't have all this content and you just had to like learn from each other. And there was all this whole language that was hard to learn and access to it was hard. So to your point, you had to kind of like be in the network. I got lucky by being in the NC State Entrepreneurial Network, which is kind of where I got my mentorship. So I think that has torn down barriers too at a more macro level. That this information is freely available to everybody.
Yeah, I would agree. I was a couple months back. I was at the Global Entrepreneurship Congress, and Mark Cuban was the closing keynote. And his parting thought was, or declaration to the several thousand people in attendance: "There's never in the history of the world, there's never been an easier time to start a business, and more information to support you to do that, and more ability or tools." And he was specifically addressing AI. And he said, so just go do something, like start something. And, those of us with a few more years on, like you and I have, I mean, we can relate to that statement. I mean, I remember in a past company, you know, writing the first commerce enabled website for a Fortune 500 company, and we charged them over $1 million to do it
Yep.
because SSL wasn't a thing yet. Like you didn't have a shopping cart. You couldn't just go to GoDaddy and, pay for a certificate and just make it happen. And you can do all of that now, including like addressing the longest end of the tail possible, where you can have a viable business doing, addressing like 1/10% of the total addressable market. Like that's just didn't exist back then.
It's good you mentioned Mark Cuban because that culturally, I mentioned there was this point in time around 2014, 15 where entrepreneurship just hit an elbow, and I think Shark Tank had a role in that. A lot of people in my cohort view it as cheesy and like the pitch is kind of like super super overdone and things. That's just TV. If you go to like one of these classes at State or anywhere where they've self-selected into entrepreneurship and you ask the question, I always ask how many of you have watched Shark Tank, and like 80% of the people raise their hand. So it is kind of it helps people conceptualize what it's like to be an entrepreneur and demystified it itself as well. That's been a big, huge cultural thing for entrepreneurship.
So here's yet another coincidence, right? So right before Shark Tank came out and became a thing, they reached out to us at the Kauffman Foundation. And I took phone calls with the producers, and they were pitching us the concept of what would become the show. And since Kauffman is, quote, the foundation of entrepreneurship, or at least it was at the time, they wanted endorsement and help like drumming up interest in it. And so they were pitching me the concept, and I was like, okay, I get it. That could be interesting. But man, I know so many first time entrepreneurs, and in my own experiences, right? Like it wasn't until like my fifth company that I even had any confidence at all. And you're going to have cameras rolling, and you're going to be asking them to do on the spot, valuations. Like we kind of at Coffin, we had this little bit of a Hippocratic oath. So I remember pitching them like, hey, how about if you did like a shark repellent, and could we have like the shark cage? Like where, they were telling me about like, the kind of like we could phone a friend or something like that. And they were very funny. They were kind of like patting me on the head metaphorically saying, why don't you leave the TV making to us? And they figured out at that point, they didn't really need any endorsement from the Kauffman Foundation. But I still remember fondly thinking like, wow, that really did. Because when we parted ways on that conversation, honestly, I'm like somebody that passed on investing in Amazon back in the day. I thought like, oh, there's no way that's going to be successful. And boy, did they prove me wrong. But that's pretty funny that, again, that's something where we have something in common there. So let me ask you something. And because of who you are and your status and your accomplishments and your reputation, I know you have said many times you're a great cheerleader for the ecosystem of the triangle in particular, but broadly the state. That doesn't mean we couldn't do things better, right?
Mhm.
There's always room for improvement. I know that this has been kind of a hallmark of obsessive customer service in your past companies, and how you always try to distinguish and build value there. Like from your perspective, where can we improve, even if it's on the margins, right? Like what's lacking, or what could we be doing better, so that like when people are talking about this, the best states in the country to start and grow high impact companies, it's not going to be the usual, California, New York, Massachusetts, Texas. Like how do we make that top three?
Everyone always says we need more funding, and let me give you a more nuanced answer. We have more funding than we've had in a long time, but it's elevated up to kind of a little bit later stage. So they want to write $2 million checks. So they're at like what we would call a price seed, a late seed, or an early A, somewhere in there, which is good. But now it's created. So they used to be here, and they elevated a little bit in the life cycle. If the life cycle starts at 0 and goes up, they used to be kind of like pretty lower. They'd write smaller checks, and now they're up here. And then you and I are down here writing 25 and 50K checks. We need a seed fund that's going to do like $200,000 to $500,000 checks. So that's our biggest gap right now, to be really specific.
So that's not the usual suspects. That it's not co-founders and IFP and
It's unusual for them now to do that low.
yeah. I was asking kind of just to tee you up to say it.
Yeah, they used to, right? And they kind of were known for that. But now their structure, they're like $80 million funds, and just the way that it's not their fault, it's just it's part of their success. So that there's this gap in there that's really hard for people to get through. Now, companies come from outside the area, but that's the hardest. Companies coming from outside the area would much prefer to compete with the local guys at that at the $2 million plus check. Because it's just, they want to have more hands-on, and being remote, you can't really be hands-on. There are a couple like Knoll Ventures and a couple others that do come in from Atlanta or DC that will write those level checks, but they're few and far between. So, and then the other thing I don't understand, and you're more of a political creature by nature of what you do than I am, which I thank you for doing that, because it's not my wheelhouse. You know, and I've been at this 30 years. The first 15 years, all these big name Silicon Valley guys would come to town. I'm like, oh, great. They're coming here looking for companies. They would meet with me. Then I realized pretty quick, I'd say, where are you going? Or who else are you meeting? Like, oh, I'm going to visit the Treasury office and, UNC's endowment and Duke's and so on and so forth. And then, and a teacher union or something like that. And I was like, oh, you came here for money.
They're extracting.
Yeah, they're extracting all this money, taking it to Silicon Valley and investing it in their startups. So I don't understand why, and these things are so big, you probably know them more than I do, but all these things are 10, 100, hundreds of billions of dollars. And, they're sending a pretty big chunk. All you have to do is take 0.1% of that and keep it here locally, and it would have a huge economic impact. So I wish there was like some way for more of that money that goes out west and goes into startups to stay here. Because I think that would be a great way to, kind of source. I don't care who does it, but it could even be like Bull City or whoever gets the money, or maybe it's spread across. But someone should then take that and put it where I'm talking about. That's that one gap of where we need more money.
Yeah, we not surprisingly concur wholeheartedly. In kind of a similar vein, everybody that we fund, the grant is a contractual agreement. It's non-dilutive, so free money. So short of Uncle Scot writing you a check with no expectation of ever being repaid, there's no better money on the street. But we still have to like report data, and those are all IRS regulations for expenditure responsibilities and things like that. And so we track them, and over the last couple of years in particular, last time we did this lookup is about 9 months old now, but about 9 months, 10 months ago, we looked it up, and that for the 20 prior months, our companies collectively had raised something like 178 million, and over 70% of that came from funds outside the state. So Scott, I ask you, as an LP in multiple funds, what do the LPs in these funds in other states, or maybe the better question is, what are the MPs, the managing partners in these other funds in other states, what do they see in our companies that our funds do not?
They see our areas underfunded and our companies are cheaper.
Yeah,
so
bargain.
So we're a bargain, and there's a lot of VCs that know if you're not Sequoia, Andreessen Horowitz, Kleiner, Kozla, you know the list, in the Silicon Valley, then you're not going to the entrepreneurs are going to choose the blue chip funders. So then they have to go, many of them have a thesis that includes some local, but then they start hunting around. Um, and, one of the unintended consequences of Tweener Fund is, so there's these league tables that PitchBook puts out, and so there's 3 data sources out there. There's CB Insights, PitchBook, and Crunchbase. Um, so so because we invest so frequently, we do 10 to 15 investments a quarter, 40 to 60 a year. We're always showing up in the league tables. It'll say Triangle Tweener Fund #1 in the state, in the Southeast, and we're like the number 24 investor in the U.S. From a deal. The hack is we're investing 50K checks and they're investing 5 million, but I didn't make the rules, so
Right.
we're not breaking the rules. Because of that, we punch way above our weight on a national PR perspective across VC. So therefore, we get a lot of inbounds. So we have like 300 funds that follow our portfolio really closely. So part of our mission is to cheerlead outside the area for our startups and get them the funding they need. So hopefully we played a role in some of that 170 million. But we get to talk to all these folks, and what they say is the quality of companies here for the price is just amazing, and they all want to spend more time here. Most of them come here for a CED event, or a lot are starting to come for Raleigh Durham Startup Week, and they really want to invest more in the area. So our companies are very hot outside the area.
Yeah, I'm seeing that as well. And I think competition is good, right?
Yeah, it keeps the local guys honest. There was a time where some of them would just kind of say, our maximum valuation is $1 million, take it or leave it, and people had to take it. And now those days are over.
Yes, they are, mercifully. That's the one area that we've always, you said it politely. I'm more political. That I will chance the occasional offense by saying a few things that need to be said. I mean, we're a private foundation, so and we serve founders. That if I had one thing I could say to every investor tuning into this, even though we provide a service to your deal flow in de-risking and helping identify high potential, kind of the best stuff coming up, which is why many of them have loaned, folks to being in our core review, so they get to see it first. And maybe
Mhm.
not this cycle they'll be thinking about it, but when they see it 6 months later, they'll remember they saw it here. That's all good. But at the end of the day, I still serve the founders, right? That's my primary client, so to speak. So we feel an obligation to use our voice and say things like, at the state level, why are we giving an incentive package of $900 million? And I know it's deferred tax collection. It's not like we didn't stroke a check for almost $1 billion to bribe Apple, to come here or whatever. But if we took a fraction, and you made this point earlier, if we took a fraction, from an incentive package standpoint, and we said we would slide that in to support entrepreneurship, the ROI on that, the efficiency of that, the job creation engine that's hiding in plain sight would outpace any ROI they're getting on these deals.
Yeah, absolutely.
And I haven't cracked the code yet to figure out how we help people find the political will and courage to think about that. And I think it's especially hard in North Carolina because, we are a state that gets a huge dopamine hit when your favorite television station, CNBC, says, North Carolina, best state in the nation for doing business. Arrgh,
Yep.
And so as long as you're bragging about that, and that is, that's your high watermark, how are we going to compete? To say, hey, remember us little guys over here? Because every one of these big companies that you just go gaga over, keep in mind, they started as a startup, right?
Yeah.
Bezos was just Bezos before there was Amazon. And if you ever have any advice, or you probably have access to much more significant halls of power than I do, but feel free to give me advice, because we're going to just keep fighting that fight, and I'll keep mouthing off on occasion, at least until it gets me fired.
I haven't spent any time on it. I think you have to give money to do all that, and I'm not super political, so I haven't crossed that Rubicon yet.
And as we are a private foundation, we're not allowed to legally do that. At least in, I don't know if there's been an executive order issued in the last 24 hours to change that, but for us at the moment, we have to be actually very specifically non-specific when it comes to policy endorsement. But I think for general practices, what we're really trying to do is help redefine best practices in economic development using the lens of entrepreneurship. And I think that's a great way to level the playing field and lift everybody up. So, all of that said, I know one of your current passions is really leveraging AI. I can't say that I understood everything in one of your podcasts around AI that you were using and how it's affecting online consumer patterns and behaviors. But I'd be remiss if I let you get off this podcast and we at least didn't get your take on how AI is reshaping entrepreneurship.
Yeah, let's kind of keep it on how it impacts startups. We're seeing, we had a couple use cases of this, examples of this over history in the Triangle. So Archive Social, Kevel, which used to be called AdZerk, they were what we would call seed strapped. And James Avery at Kevel kind of coined this team where you used to have bootstrapped or VC backed. This is like a middle thing where you raise a little bit of VC on the front end, but then you use it to slingshot yourself to where you don't need more. Sometimes in traditional VC, like kind of Todd at Pindo and I do, is you get into this alphabet soup where you're like, all right, I'm on the treadmill. I raised a series seed, then I do an A, B, C, D, E, F. You can go all the way, to infinity on the alphabet, I guess. And, you know, but that was really hard with software as a service companies because you have this dynamic where the revenue, because the revenue is spread out into the future, unlike going back to your COBOL days, you get all your revenue up front, and people would pay a lot up front for the on-prem software, but then you just got maintenance after that. So you're totally having to you always had to close new deals to stay to feed the engine, but it was doable to do that bootstrapped, and you can do some SaaS bootstrapped. It just takes forever. So if you want to go fast and do SaaS, you have to raise capital because SaaS, you have to pay all your sales reps now, and then the money comes over the next 10 years. So it's it's a liquidity problem that's created by that problem. But what AI does is if you can make the rest of the org so hyper efficient, we know many companies, and at Tweener Fund, what we're doing is for AI companies, we're investing earlier than the million because they're going so fast, we will miss them. We'll meet them when they're doing 20K a month. And the next time we check in, they're doing 200K a month. And we're like, wait a minute, that's crazy. So we're coming in earlier and earlier. And so you have the dynamic of they're getting to 1 million, 3 million, 5 million ARR faster. And they're doing it with less people, therefore they can get profitable. So I think that's the most interesting thing for our ecosystem and venture capital, because what happens to the late stage investor in that world? I think there's going to be a whole rethinking of the venture cycle. That's one of the things that gives me hope that all that money is going to have to go somewhere. And I think it'll either have to exit stage left or it will have to go into seed. And maybe we will see more seed funds be created and kind of go back to that 250, 500 check, because I think that's where all the action is going to be, because I think the late stage is going to dry up.
That's an interesting point. And it's funny that you say that. Yet another coincidence. We share a company that happened exactly to us as well, because micros are very early stage concept. And then we hope for the vast majority to, if they get the micro, they hit their wickets, and then they're competitive for seed for 50 in 6 to 12 months. On a rare occasion, someone will get a micro and then they just leapfrog. They accelerate so fast, they're like ineligible because they're already at 1 million plus, or they've already raised, 1 million before our next grant cycle even opened. And we wish them well. This is not a knock on them. It's way largely
it's a win.
Credit.
Yeah,
it's a win. But it was Planted. Planted came in. Huada came in. They were the original pitch that we gave them the micro for was that the composite material, instead of OSB siding, it was going to be for indoor rock climbing wall handholds.
Huh? I did not know that.
Like, that's an enormous TAM of at least 50 million.
Yeah.
I mean, it was laughable, right? But that was one where we looked at it and go, oh, we're betting on the jockey here. This is the horse. It's not the right color yet. And they're going to figure out what color to paint it and how many legs it's going to need. But this jockey is going to take this far. And so the time that they got the micro to when they would have been coming up on seed, they were already halfway to the moon.
Have you gone to see their facility yet? That's a really cool tour. Yeah.
I have. I've been there. I've been there a couple. I've had the pleasure to be there several times, and I've got a. It was just a coincidence. It has nothing to do with any connection, but I have a nephew that's doing his summer internship there as we speak, and so I get a nice little debrief most evenings on like what it's like to work there. And
I bet he's learning so much. It must be insane.
he is. He's a mechanical engineer, upcoming senior at UCS, UC Santa Barbara. So he's a West Coast kid, but
He's a gaucho, whatever that is.
yes, he is. But he's having a great experience. And how cool was it, right? Like because those kids just aspire to go to LA or San Francisco, and and to be honest, he was trying to get into carbon 3D. That was also on his list for the summer internship. But I was like, you ought to check out this company down here called Planted.
Yep. And now he's on a farm in, what is it, Oxnard? It's got a weird name like that.
Oxford,
okay.
Oxford, North Carolina.
Yeah.
And he's just had a great experience doing that. So listen, I could talk to you forever. My producer, Christian, has given me the hook here. So I like to close these with a little common thing for anybody that pays attention. That is just, this is about networking, right? And the podcast is titled Ecosysteming, connecting people and sharing and being stronger together. So I always look at LinkedIn and say, if you had to venture a guess as to how many mutual connections you and I have, what might you speculate?
1,250.
You are very close. And it's 1,153, based upon at least what LinkedIn's telling me. And for me personally, of the guests that we've had, that's a new record. So Ted Zoller had the record. Ted and I had the record before that at about 1,100. But you and I have now come in at 1,153.
Nice. Yeah, good.
Yeah, not surprising.
You hang out with really cool people.
I mean, I must.
But I may be biased.
From this point forward, if I want to impress anybody, I'm going to say, I had Scott Wingo on my podcast. What's your claim to fame?
My claim? Yeah. Mine is I have over 1,000 mutuals with Tom Rue.
Yeah. See what that gets you. With that said, and all kidding aside, Scott, thank you. And thanks again for being, frankly, a patron saint of entrepreneurship in the ecosystem. You're giving back more than you know. And
Thanks.
I can say that from an informed position of doing this for a few years.
Thanks. I'd be a bad journal partner if I didn't end with a little pitch. If folks want to learn more, go to tweenerfund.com. The only, you have to be an accredited investor, and those requirements are outlined by the SEC. That's their rule, not mine. And those requirements are kind of coming down a little bit, which is good. And yeah, you can invest and have an impact on the Triangle ecosystem for $30,000 and build a risk-adjusted, diverse index of startups.
That will also you can do well by doing good. That's my pitch. I'm not putting those words in Scott's mouth, but that's my pitch.
That's good. Yes.
Thanks again. Great catching up with you, and I'll see you around the ecosystem.
All right. You too. Thanks for having me, Tom.
Stay connected with NC Idea on LinkedIn and Facebook, and subscribe to our newsletter for all the latest as we celebrate our 20th year. Catch new episodes of Ecosysteming every other Tuesday. Thanks for tuning in and being a part of this thing of ours.